That has nothing to do with the interconnectedness of the commercial banking and the investment banking world. The idea that what we're trying to do is to say that if it were a non-commercial bank with non-deposits, we would not care whether or not it failed from a systemic risk issue, which is how it's normally framed, which is all we care about is protecting the taxpayers in terms of the insurance fisc that's there for the FDIC, et cetera, is just simply a mistake. There is a separate requirement, there is a separate benefit to allowing individual depositors to put their money in a bank and not have to worry about whether or not that bank is solvent enough for them to be protected in the event that there is a failure. They want to have government insurance. That makes absolute sense. It's the equivalent, if you will, of being able to walk into a restaurant and not having to inspect the kitchen to decide whether or not it's clean enough for you to want to eat there. Nobody in their right mind would want to eliminate that kind of protection or that kind of benefit. It provides, in essence, a much more efficient marketplace for all of us if you can put your money into a bank without having to necessarily examine its financial statements as an individual depositor. That part's good. That's separate from the issue of whether or not there's systemic risk. And the concept of systemic risk has to do with the interconnectedness and the size of an awful lot of institutions throughout the economy, and what happens if you got a seizure of one of them that could actually stop others from being able to create lending or provide facilities, and what you end up with is the economy basically grinding to a halt. That's what we were afraid was occurring after Lehman. That was what people were trying to solve for. Being able to just separate commercial banking and investment banking is not going to solve that problem.
Okay. There are a lot of different ways, I think, to do it. One of the, and I'm not the world's most famous banking expert, but one of the looking at the past, the point I was trying to make, a lot of government subsidized intervention in this thing and creating a moral hazard and encouraging more risky behavior rather than less. But beyond that, going to the future, what we have is banks that have access to the Fed window now, investment banks, access to FDIC guarantees. It's sort of an implicit guarantee of non-failure, and they will have borrowing costs much lower than entities that don't have this kind of advantage. And maybe you can address that. That's what bothers me. If you think about this new $3 trillion carbon market, the notion of firms with access to the Fed window being able to outbid utilities that actually have to have these allowances in order to stay in business and heat your homes, I don't think that's right. And another problem is I don't know why normal antitrust analysis should not apply to these banks. I know there's, legally there are questions of primary jurisdiction and maybe the Fed and maybe the Treasury, but we don't know what the structure ought to be. That's one of the questions. And why not take a look at what antitrust laws would do if given a chance to? Joe Ackerman, head of Deutsche Bank, said that his bank and 3 or 4 others have about 100% of the wholesale banking market. And he said, that is a very dicey situation. And I don't know whether the antitrust laws could apply to that or look at that and say what we ought to do or not. I think they could. I don't know what's so different about banking. I know there's systemic risk, but Jamie Dimon this morning is comparing himself to big multinational companies. Well, if you want that comparison, you ought to take the other pieces of it.
Okay. I guess in the interest of equal time, I should take another from the back, and then we'll rotate.
Okay. Nate Fisher from Harvard. It seems like that if we're going to bail out these companies, there's a lot of talk that the government should be regulating pay packages to discourage excessive risk-taking. And this has led to limits on levels of pay and on structures of pay. And we had Ken Feinberg in class on Monday talking about how he doesn't think that higher pay necessarily leads to better performance, while pay that's too front-loaded can lead to excessive risk-taking. So could Mr. Greenberg in particular comment on whether you think this is true and whether you think this is going to handicap business, or whether you think it's going to, I guess, lead to better management down the road?
Well, I think it's very clear that if you're trying to pay the taxpayer back and you're losing all your most experienced people because you have a limit of $200,000 in pay, that's exactly what is happening, which doesn't make any sense. Now, AIG over many years, the maximum salary, for example, that I got was $1 million a year because that's all you had tax deduction for. And any bonus was based on performance. And most of the wealth was created by long-term benefit of stock options and appreciation thereon. So we had a long-term view of it. But you're now in a crisis mode. Everything the government has forced AIG to sell has been sold at either below book value or just a bargain sale. Nothing is from that has paid back the taxpayer. So you have people leaving because they are not being adequately compensated, and I think that system is not going to work. And so I think that either you have management that the government has confidence in, or they don't. And if they're going to try and second guess everything the manager is doing, this thing will fall apart.
Okay, go ahead.
Okay, my question's for the panel in general, but in specific to a comment made by Mr. Wallman. He said we're past the world of Adam Smith, and it's much more complicated than that. And granted, the complexities are definitely enhanced in the modern world, but maybe if we return to first principles, we could learn something. And listening to the panel, I think there might be a little bit of a focus on systemic risk in the abstract, where maybe the problem is not eliminating systemic risk, but making sure individuals internalize the risk that they take. Because the less an individual is responsible for the risk that he takes, that creates the systemic risk. So I think we need to separate individual risk versus systemic risk. And just two quick examples on how by not internalizing your own risk, it may have created this problem is the originating bank that made the subprime loan, knowing that it could turn around in 3 months and sell a loan. It didn't internalize the risks associated with that. Second is also credit default swaps. If you have no interest in the underlying investment, you can short it, you can play games, so you're playing both sides of the game. It's kind of like buying life insurance. The analogy I've heard is buying life insurance on somebody else's life, and then you keep going out and killing them. And then just last thing about this consumer protection group that was our regulatory agency in terms of monitoring loans. I think that would maybe enhance a problem because once again, if there's some government agency monitoring an individual's mortgage, that individual might say, well, if the government says I can make this mortgage, I'll do it, and then they won't internalize the risk. So you run the problem of maybe enhancing risk through the remedy. So if you want to address that, thank you.
Yeah, I'd like to add something to that. I think the commission, should there be one, should look into, for example, were there synthetic portfolios of underlying CDOs compiled in some organization, and then buying a CDS, and then shorting that and shorting the stock of the company. There may be all kinds of things that went on. People are asking those questions, and hence, and there's lots of investigative reporters who are trying to get answers to that. And so a commission would benefit the entire financial services industry. If those things did occur, it seems to me that we have an obligation to find out about it.
Okay. Any other
Going
comments?
to the question, I absolutely agree, and I think it's a very good question with regard to the issue of can we get back to first principles, and are there ways to do it? And I think that that's part of the analysis that needs to be done. The question as to whether or not you can internalize the risk or force people to internalize the risk is a really interesting one. I think a lot of people have thought about how to do that. There have been some efforts now, for example, to say that if you're going to securitize any kind of instrument, whether it be mortgages or something else, whoever is the securitizing originator needs to keep a piece of that and therefore be somewhat responsible for it.